Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, forget the scandals and scrutiny from Congress. Facebook's shrinking margins are making investors think twice. Can the social media giant jumpstart earnings as user growth plateaus? Plus, Bumble puts women first in the online dating game. Now the company is turning that attitude towards investment. We'll hear from CEO Whitney on her plans to invest in other women. And feeling the burn, how a torrent of rejection can turn into a fitness media empire. But first to our top story. Facebook has had quite the year filled with data privacy scandals, lawmaker scrutiny, slowing user growth. And yet, the social network's shrinking margins are giving investors the most pause. As the tech giant shares continue to languish in the aftermath of its $121 billion one-day plunge in July, Facebook will need to show that it can jumpstart earnings growth to restore faith with investors who've been reluctant to buy. Joining us now, Bloomberg Tech Sarah Friar, who covers Facebook and attended the hearings in Washington on Wednesday. Also with us from LA, Wedbush analyst Michael Pachter, who has an outperform rating and a $250 price target on Facebook. Sarah, I'll start with you. You were in the room at these hearings. We're seeing Facebook open down again. What are investors hesitating about here?
Well, I think that what investors are worried about and what Congress is worried about are two very different things. Facebook is trying to say that they're investing a lot in protecting their site from election interference, from ads that are targeting people for discriminatory reasons, hate speech, all these things that we've come to know are problems with Facebook. They're investing in fixing them. What investors are worried about is that Facebook's main product, the news feed, the ads on it, they're starting to run out of room to grow that advertising business because so many people around the world use news feed already. They're not going to increase the frequency of ads in the news feed. And so the future of Facebook's business is going to depend on other bets like messaging ads and like Instagram stories and like virtual reality. And all of those things are a lot more experimental, and the expenses keep going up and the margins keep narrowing.
So, Michael, Facebook has a lot of irons in the fire, and yet you are concerned that Facebook's earnings, their margins, are shrinking. Do you think Facebook can change that in the future?
Oh, it's fully discretionary. I mean, I don't think that we're going to see legislators compel them to do anything that they weren't planning to do. I really think, when we talk about compressing margins, they're investing in a bunch of things like virtual reality and artificial intelligence. And they're obviously trying to build out some of the businesses that aren't monetizing as well as the Facebook platform, like WhatsApp, and obviously building out advertising on Instagram. I think it's not the compressing margins that spook people. I think it's Dave Wehner's commentary on the last earnings call. And, this company's tracking to low to mid 40s in operating margin percentage this year. And he said to expect mid to high 30s going forward. And just to kind of put that in context, that would require them to grow their spending by about 50% of their revenue growth in the next 5 years. That just doesn't compute. If they grow revenues by 50 billion or 100 billion in the next several years, how are they going to spend half of that again above what they're spending now? Crazy. It's crazy talk. He said it. I'm not sure why he said it. I'm not even sure that that's his decision to make. That's the board's decision to make. And I think that with the share price, stumbling down to the 160s, I think that their board's going to get an earful from their shareholders. And I think Dave's going to change his tune. So I think it was imprudent of him to say that they were going to see margin compression in the next several years. I think they're going to change the story when they have their next earnings call.
Dave Wehner, the CFO of Facebook. Sarah, Michael Pachter, not mincing words there. Do you think it's crazy talk? Do you think it's imprudent?
Do I think?
Do you think?
Well, I mean, here's what happens with these earnings calls. Facebook says something that gets everyone concerned about whether they're going to be able to make their numbers in the future. It takes down expectations a little bit, and then the next earnings call, they don't spend as much as they said they were going to. They maybe beat the revenue that they said they would, that they said they wouldn't beat. So I think that there's a little bit of expectation setting here. It's true that Facebook's overall business is going to grow less fast. It's true they're going to have to spend a lot more to grow in new areas, but whether it's going to be doom for the business, I mean, they have so many different properties that they could turn up the lever on, but all of that is going to be a lot more experimental than what they've already done. So I just think they don't know how successful these other business initiatives are going to be, and they don't want to promise that they'll be just as successful as the newsfeed, which is one of the most lucrative products ever.
So, Michael, as Sarah mentioned at the start, what investors are concerned about and what Congress is concerned about are two different things. But are you concerned, as an analyst who covers the company, about Congress's scrutiny of Facebook and tech more broadly, about the Department of Justice now asking more questions about tech giants and their power? That can't be good either.
Emily, I think you know I'm a recovering lawyer. I did it for over 15 years, and I've been licensed for over 30. The Justice Department has very little power to do anything. I think there's this perception on Wall Street that there's such a thing as too big, and antitrust breaks up big companies. That's just not true. If a company is so big that it has market power and pricing power, then sure. And we saw that, with AT&T's breakup and Standard Oil's breakup, a century ago. That's not the case with Facebook. I mean, you can say they're the only social platform, but it's not like Google hasn't tried. And Google failed because Google did a poor job. But anybody who wants to compete can. Google with 93% search, share, whatever the heck it is. Bing is trying to capture share. Yahoo used to try to capture share. So, I don't think these guys have pricing power, nor do I think they actually exert pricing power. I do think Congress can legislate. I don't think the Justice Department will find anything, but I think Congress can legislate and require that these guys take steps to ensure user privacy and security. That's appropriate. But remember, these guys are businesses, and with the exception of all the commentary from Jack Dorsey yesterday, who seems to think that he's a public interest organization, or he's running a public interest organization, these guys are trying to make money. And the way you make money is you keep your users happy, and you keep your advertisers happy that they're going to reach your users. So you've got to do both. And to keep users happy, you have to make sure you protect them. And it's protect their privacy, protect them from hate speech, protect them from threats, whatever it might be. And I think you might see legislation that says, that you have to do those things. I think these companies are going to do that. The president's commentary about, Google's algorithm being biased, I apologize, but it's just idiotic. It shows his complete lack of understanding of how algorithms work. And, the fact is that we all have sample bias. If I watch Emily Chang on Bloomberg all the time and I search it all the time, then if I type in Bloomberg, Emily Chang's going to pop up. I mean, obviously. And so we get search results based on our behavior. Whoever did that search for Trump clearly reads the New York Times and watches CNN, and that's why that popped up, not because Google is biased. So I really don't fear a financial impact. I think Sarah's right that companies who promise something and then don't deliver, stocks go down. The solution to that is don't promise. And Dave Wehner did not need to talk about 5 years out because he doesn't know. Remember what Amazon did a few years ago. They were losing money. They were doing stupid things like the Fire Phone. The stock was in the 200s. As soon as they stopped spending all of their profit growth, all their gross profit dollar growth, the stock started to rip. It's up 500% in the last 3 years. So if Facebook decides to do the same thing, I think its stock's going to go on a pretty steep upward trajectory.
Michael Pachter, we never wonder what you're thinking, and now we know what you're watching as well. Good to know. Michael Pachter of Wedbush Securities, as always, and Sarah Friar, who covers Facebook for Bloomberg. Thank you both. A story we continue to watch. CBS is reportedly in talks that could lead to the departure of CEO Les Moonves. CNBC says that Chief Operating Officer Joe Iannello would replace Moonves as interim CEO. He's being investigated over claims Moonves is of sexual harassment. At issue now, just how much of his original $180 million golden parachute will Moonves receive? Joining us now for more, Bloomberg's Chris Palmieri from LA. Chris, what do we know?
Well, the headline here is that this is the end of the era for one of the longest-running media executives, Les Moonves. It seems to be not a question of if, but when. And there are some things we still don't know. We're hearing numbers somewhere between $100 million and $200 million in terms of a payout. And I think that's in part due to the fact that these negotiations are ongoing.
So talk to us about the negotiations in terms of the pay package here. You know, what is he entitled to if he's leaving under these circumstances?
Well, it's obviously a different story if you're fired versus if you leave as a result of a merger or something. And so this is why it's a negotiation. I mean, he's leaving obviously because there have been these allegations of sexual harassment against him. There's 2 law firms investigating. And so the idea is to sort of get him out the door before those results are released. But this isn't necessarily a firing, so he's going to negotiate some large payout. He's always been a fantastic negotiator and one of the highest paid CEOs in the business.
Indeed, he has. Les Moonves in negotiations with CBS. Bloomberg's Chris Palmieri, I know you'll keep us posted on these negotiations. Well, dating app Bumble has been battling Tinder in court and fending off Facebook's efforts to get into online dating. Now, it is looking beyond empowering women to investing in them as well. We'll hear from Bumble CEO Whitney Wolfe-Herd next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. In 2012, Whitney Wolfe-Herd was the only woman on Tinder's founding team. When she left the company 2 years later, however, she didn't leave the dating app scene. She decided to flip the switch on it. Wolfe-Herd launched Bumble, the female-first app where women make the first move. Today, the company is one of Tinder's biggest competitors, having facilitated over 500 million connections. And now Wolfe-Herd is investing in other women as well. Last month, the company launched the Bumble Fund, a fund focused on investing in female-founded and led businesses. Joining me today here in the studio, Bumble CEO Whitney Wolfe-Herd. Thank you so much for being here.
Thank you for having me. I'm so excited to be here.
So we'll talk about the fund, but I want to talk about competition first, because obviously Tinder is there. They've been mimicking a lot of your features. You have Facebook getting into the online dating business as well. How does Bumble continue to differentiate itself from the competition?
So we're generally flattered when a competitor wants to come into our unique space. And what we really stay focused on is being true to ourselves. We were founded based on values, and we're a mission-driven company, and there's authenticity to that. And so as long as we stay true to that and we just keep innovating beyond that, we're really not too concerned about competition. And candidly, Facebook has been in the dating business since Facebook started. The fact that they're actually attaching a label to that is actually hugely validating to the entire dating industry. And Bumble has evolved beyond dating. We're a full-fledged social network for people you don't know yet now.
So let's talk about the non-dating features. Friends, professional networking. Is that a foreshadowing of what's to come or what you want Bumble to become?
So the big vision of Bumble is to be the global empowerment brand. And we want to bring good people together at every level of their life. So that should not just bring you a date or a friend or a business partner. We really want to connect you across the board. And nobody in our space has ever been able to successfully do that. And so the fact that we've been able to foray into friend finding, networking successfully, and show that we have this lifetime value of when somebody meets a significant other, we don't lose that user. They can stay on our platform and friend find or connect for business. This is really showing that we can be this global platform for introducing you to people you don't know yet.
Now, when you launched, you really changed up the norms. You know, women make the first move, and I'm curious how the trends have changed. Is that the norm now, and where do you see the online dating trends going?
Sure. So yes, when we launched, we were the only platform to ever really put women out there and empower them to be confident and to own making the first move. Traditionally, gender norms suggested men always had to chase women, and you saw that spill over into the digital sphere. And so as we evolve with this incredible momentum of women becoming more empowered, we are also going to evolve. And Bumble is in such a right position to just continue building upon that and giving women more control through features and evolving even beyond where we are today, and I think you'll see a lot of that in the coming year.
So you've launched a new feature, Snooze,
Yes.
which allows people to take a break from online dating. Why can't they just put their phone down? Why can't they just log out of the app?
So when was the last time you just put your phone down, right? I'm right there with you. So this feature is actually a great way to kind of build upon our values. We really want to engineer accountability, and we want to eliminate rejection. So just putting your phone down and ignoring conversations, that's not pleasant for either party on either end. And so we really want to empower our users to take a break when they need to. And what's the beauty of Bumble, why we're not nervous about losing our bottom line or losing our users, is at the end of the day, we all need human connection. Even if we take a break for a moment, we need to connect. We need to find love. We need to find business connections and friendship. So we will always be there, but we are encouraging our users to focus on themselves, and it just is core to who we are. You're looking at a lot of these big social media giants right now on Capitol Hill and throughout, apologizing for their lack of accountability, the lack of catering to their users and giving users a break or taking care of their users, and the lack of accountability across the board. And Bumble, really, we want to say, we've been here standing up, raising our hands, saying we're here to bring you an accountable experience. We want to engineer kindness and good behavior into the product through every single thing we do, and we've been doing that from day one. So it's really fascinating to see these giants right now kind of apologizing, and here we are saying we've been doing this from the very beginning.
So let's talk about one of the giants in the online dating space, which is Match, the parent company of Tinder. They sued you for patent infringement. You sued them back. I know you cannot talk about ongoing lawsuits, but how would you describe your relationship status with Match now? And are these lawsuits impacting you, the company? Is it impacting investor sentiment?
First of all, we're not raising money at the moment, and our growth is not impacted by any means. Our users don't care about what type of a lawsuit the company might be in right now. And by the way, we're staying so focused, we're so on track. And with growth, with scaling at such a level, comes challenges. And we're willing to weather the storm with whatever comes our way. But I have nothing but respect for their current CEO. I think she's a remarkable woman, and I think that we're just going to keep doing our thing, keep innovating, keep building and adding value to our users, and we'll see what happens.
They bought Hinge, which was sort of just stomping on your territory. Does that change the landscape for you in terms of public or private? Going forward, what's the vision?
The big vision is to add as much value to the users and grow exponentially. We are going super international in the coming year and beyond. So the focus right now is going deeper into our existing markets, which will just penetrate the markets we've already had exponential growth in, and then really, really proving that we can be this global, international, high scale, very scalable brand. And what they choose to acquire and what they choose to do, that's their own business, and we wish them all nothing but the best.
So I have to ask you about the fund.
Yes.
You're investing in women and women-focused companies. Is the goal here to find technology that you could use, or is this just for the greater good?
There's a mixture of both, right? And I think we can add a lot of value to these new startups, but we really want to be there to help build the future of tomorrow. And we truly believe that the more women behind these new businesses, building their dreams, building the solutions to problems that we're all experiencing every day, that will be a better tomorrow. And Bumble is at a place now where we have both the capital and the intellectual capital to help expand our reach. And what better way to build a more empowered future for women than to actually invest in them and share not only capital in a financial contribution, but what our team has learned over the years, and that will ultimately add value to us. So it's really expanding into this global empowerment brand and being at the forefront of connecting people on every different level.
Bumble CEO and founder Whitney Wolford, great to have you here.
So nice to be here.
Thank you.
Thank you for having me.
All right, still ahead, veteran venture capitalist Jenny Lee has some frank advice for companies out there shopping for investment. We'll hear from her in just a moment. And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network TikTok on Twitter. This is Bloomberg. It is harder than ever to get multi-billion-dollar unicorns in highly competitive markets, according to veteran venture capitalist Jenny Lee of GGV Capital. Speaking at the Bloomberg Sooner Than You Think Tech Summit in Singapore, she told our chief international correspondent for Southeast Asia, Haslinda Amin, that companies out there shopping for investing must lower their expectations.
We've seen that the public valuation has come down, quite substantially relative to the growth of private valuation. So that's a fact. I do believe that private companies that are in the market trying to fundraise would have to adjust their expectation in terms of what it means, right? Can you continue to be multi-billion? Is it just growing on the billion side? Or is it really, let's get back to fundamentals, let's get back to growth, let's get back to innovation, and worry less about valuation on the private side. I think at some point it's gonna the public valuation. I like to tell our companies that Mr. Market is always right. And so even if you're a private company, you have to manage that expectation and not let private valuation tell you that you're there or that you made it.
But having said that, though, do you think Chinese tech companies can withstand the shocks in the market?
Yeah, so we've been investing in China and US for the last 18 years that I've seen. And I've seen 3 or 4 down cycles over the last 18 years. And these are global financial crisis, Asia crisis, a lot. What we have seen is that the Chinese entrepreneurs, if they have the ability to bring and grow their company to be top 3 in their category, they have gone through a lot. When the ride-sharing market kind of took off on a global basis, overnight we had a few hundred players offering ride-sharing services in China. And so for a Didi to get to category 1, right, to be the number 1 player, means that they have fought a tremendous battle in China across their peers who are highly competitive. And so that allows them to build a deeper base of resilience. And when companies like that tackle the international market, when they go out, when there's a downturn, these are companies, these are the survivors, right? And they will continue to survive. And that's what we have seen, is that China is a brutal market for entrepreneurs. But when you are there and you're in that category of companies that made it, if they survive over 5 years, the next 5 years becomes easier. Not taken for granted, but definitely easier.
Jenny Lee there of GGV Capital. We'll be right back with more of Bloomberg Technology. After this quick break, we're going to be talking to the CEO of Peloton, the upcoming fitness giant. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Wednesday was a jam-packed day for big tech on Capitol Hill. First, we saw Sheryl Sandberg and Jack Dorsey defend their companies to the Senate regarding Russian meddling in the 2016 elections. Then, we saw Dorsey testify before the House, answering questions more specifically on shadow banning conservative lawmakers. However, according to our next guest, the biggest news didn't come out of either. Instead, it came from the Justice Department, which came out with a statement saying it would convene a meeting of state attorneys general to talk about a growing concern that these tech companies may be hurting competition and intentionally stifling the free exchange of ideas on their platforms. To discuss, I want to bring in Bloomberg Opinion, Shira Ovide. So, Shira, we had Wedbush analyst Michael Pachter on earlier, who calls himself a recovering lawyer, and he doesn't think this DOJ situation will have any teeth at all. Why do you think differently?
And look, he might be right from a legal standpoint that it may not have any teeth, but I think the political message it sends is worrying to me. So basically, the stifling of viewpoints concern that was mentioned in the DOJ statement, that's essentially echoing views that you hear from President Trump and some other people from the conservative side of the political spectrum who believe that Google, Facebook, Twitter, and other internet companies unfairly stifle conservative viewpoints. And it's not supported by evidence, that position, but it has become kind of a pervasive view on the right. And the fact that the DOJ is opening this kind of meeting or convening a meeting based in part on that incorrect view of the internet companies, that was worrying to me, and it should be worrying to investors of those tech companies as well.
So my question is there anything political about this? We know that the Justice Department is run by Jeff Sessions, whose job is on the line. The president is very angry at him for not recusing himself from the special investigation. Could Jeff Sessions and the Justice Department be doing this just to appease the president?
That was certainly my read, that it sounded like it was an overtly political statement. And, you know, the worrying thing, again, to me, is that there are legitimate concerns about the power of the internet companies and their ability to influence what information people see and don't see. But the DOJ statement kind of hijacked those concerns for kind of nakedly political pandering.
So what could the DOJ actually do here?
Well, look, again, there are legitimate potential legal issues for these tech companies, particularly around issues like antitrust. And interestingly, you hear antitrust concerns about companies like Facebook and Amazon on both the left and the right sides of the political spectrum. And that's kind of been this interesting convergence of opinion on two sides that don't normally agree on most things. So again, if you're a tech company, that should be the focus of concerns. But any topic of interest for the DOJ, even if it doesn't ultimately lead to a legal crackdown, it causes political headaches for these tech companies, and they're already fighting political wars on multiple fronts, at multiple agencies, at multiple state levels. And, you know, eventually some of those are going to start to bite.
So what's your read on the hearings yesterday? I mean, you know, the thought is that what's happening now could lead to potential legislation, but certainly not for a long time. You know, do you think that this will lead to some tangible changes in the way these tech companies are regulated, or do you think this is just noise?
I don't know yet. I mean, that it requires something of a good read on what's happening in Washington and the ability of people in Congress to legislate, and I just can't make a call one way or the other, particularly this close to the midterm elections. I will say two things. One is, I was rather impressed by the quality of the Senate questioning yesterday in particular, that it seemed like a good faith effort on all sides by Democrats and Republicans, by Sheryl Sandberg and Jack Dorsey in the witness chairs, to tackle big questions about what's the right role for the internet in public discourse and what's the right role of government in making rules around the internet and public discourse. And I thought those were high-minded discussions. So point two, I don't know if anything is going to come of it.
All right. Bloomberg Opinions' Shira Ovide, as always, thanks so much for weighing in. Well, one investor watching the tech hearings closely is Lightspeed Ventures partner Jeremy Liu. He sat down with us at TechCrunch Disrupt here in San Francisco. He was an early investor in Snap, the earliest, in fact. I asked for his thoughts on shares of Twitter and Facebook falling amidst this congressional scrutiny and Snap getting dragged down with them.
I think that some of the biggest challenges for the social media companies have been when they haven't had a good sense for what sort of content is propagating. And so the ones that have more of a lockdown ability of controlling who is going to be putting content on the service have a better, have a more control over how that spreads.
Who do you think has a good handle on that?
Well, Snap with Discover, because it hand selects who's going to be on Discover, unlike an open platform where anyone can publish anything.
You were an early investor in Snap. We've talked about that. Snap's been getting dragged down as well. Shares are down 30% so far this year, even as they're announcing new spectacles. Is it fair for Snap to be dragged into the broader social media muck?
I believe in the company and its ability to really drive breakthrough product innovation. And you can see to what degree the innovation that Snap has delivered has really influenced the entire industry, stories being a great example. So I'm a big believer in the company and in its ability to really change the landscape.
Well, look, it's clear. Instagram and Facebook have copied many of Snap's features, including stories. That said, they have the scale and the resources to continue to do that. Like, do you think Snap can recover? And take them on.
As I said, I really believe in the team there and in their innovation. And while other companies can eventually try to emulate what they've pioneered, each time they do that, they create a step of an advance over the rest.
That said, we're seeing not just Snap, but Facebook and Twitter plateau when it comes to user growth. Do you think we're at a social media peak?
I think that what we're going to see is more usage coming from more users. And so in the West, I think it's reasonable to think that actually it's going to be harder for you to see more social media users. But as the internet continues to grow in the developing world, I think we've still got plenty more users to come.
That said, is there room for a fledgling social network, or are these it?
Well, I think people have called the top for technology many, many times. They said AOL dominates the world and there's not going to be an opportunity. And then they said Yahoo dominates and there's never going to be another opportunity. In fact, before then there was Microsoft that no one could compete with. So I believe in startups and their ability to always disrupt the status quo.
So what do you think the opportunities are? Where are you seeing growth? What are you excited about?
One of the things that I'm excited about right now is a raft of companies that are being led and founded by people who already have social followings. And so this is an interesting knock-on effect of the growth of the social media companies you've talked about. They've all allowed these influencers, whether celebrities or native to YouTube or Instagram or Snapchat, to develop a direct relationship with their followers. And that authenticity and the direct connection that their fans and followers have with them has allowed them to launch new brands. And a good example would be Jessica Alba with The Honest Company. Another good example that wasn't venture funded would be Kylie's Cosmetics by Kylie Jenner. Massive businesses, hundreds of millions of dollars in revenue, and not built off paid advertising, but off that authentic connection with fans.
It's interesting that you mentioned Kylie, because one tweet from her saying that she doesn't use Snap anymore wiped $1 billion off the company's market cap. And so, there's also a huge risk to being tied to celebrities as well.
I think that it just goes to show how powerful celebrities can be. And if they choose to build brands around that credibility that they have, then you see companies like Kylie Cosmetics or Rihanna with Fenty. And I think we're seeing, I think Gwyneth with Goop is another good example. We're seeing these really big companies being built off of people's ability to connect authentically with their fans.
So what if you're not celebrity-led or celebrity-tied, if you are one of the many, many people who've got booths at TechCrunch who want to break out? What are the prospects in this market?
I think that there's always a great deal of creativity and there's always opportunities to be seen, and that's why I'm here. I'm judging at the TechCrunch Disrupt Battlefield. We're going to see 4 exciting startups, and I'm really looking forward to hear about how they plan to break through.
So where are you putting your money right now?
We've been doing a lot of digitally native vertical brands. We're continuing to see some interesting opportunities in marketplaces. We're selectively making some investments in some potentially disruptive new media and video companies. So there's a lot of exciting stuff happening.
Lightspeed Ventures, Jeremy Liu there at TechCrunch. Coming up, feel the burn, the growing business of at-home fitness. We'll talk to the founder and CEO of Peloton. And a bit later, the tech company looking to streamline cancer treatments with a new global platform. And it's got the backing of a Hong Kong billionaire. This is Bloomberg. When Peloton launched in 2012, it had a hard time attracting investors. The company's founders struggled to convince them that blending stationary bikes and streaming live video classes would work. Remarkably, Peloton was turned down by 400 investors. Well, today the company is able to tell a different story. They have recently announced an additional $550 million in funding, bringing their valuation to $4 billion, with more plans to expand. Peloton's founder and CEO John Foley with us now here in studio. So the model was first to sell bikes, then the subscription model. And what did you believe that investors didn't?
I believe that people wanted fantastic instructor-led group fitness classes from home. And we had to build the Peloton bike platform, the technology platform, hardware and software for consuming that content. And when I was pitching the investors out here at Sand Hill Road, just down the road, I would say we're going to build tablet computers. We're going to build the best bike ever created. We're going to stream the media to those bikes. We're going to open retail stores. We're going to do logistics. And at the end of the whole pitch, they'd say, wow, this sounds capital intensive. This sounds really hard. The problem is, John, you don't know if there's a market for this product. And I'd say, well, of course, people want fantastic workout from home.
But you had to put $2,000 down first.
You had to put $2,000 down, exactly. But when you think about the category, people are paying $30 a class, or in New York, $40 a class. So if you and your live-in partner or your spouse are both doing it a couple times a week, it's a very expensive proposition. So over time, the Peloton bike at $2,000 is a fantastic investment, fantastic value.
Well, obviously it took off, but now you don't have to buy the bike. You've got this whole portfolio, you've got yoga classes, you've got studio classes. What's the vision?
So when you think about fantastic instructor-led group fitness classes at home, you think about maybe indoor cycling boot camp. So our treadmill comes out next month. We announced it earlier this year, and we already have over 10,000 pre-sales. So people want that platform. And then you think about yoga, to your point, Emily, different verticals, different categories, strength training, weight training, all these different things that you might want to do. If an instructor is there and there's a community of people motivating you at a better location, at a better value, we're excited about that opportunity globally.
Meantime, this is a market not without competition. There's SoulCycle, though their model is very different. It's really focused on in studio. How do you continue to differentiate yourself?
So at our core, we're a technology and innovation company. So when you think about the client-side software, custom Android on our platforms, our bikes and our treadmills, and then iOS and Android apps for consuming the content on the client side, we have Python services in the cloud. So we have hundreds of the best technologists in New York City, not out here in the Valley, but we think we have a pretty cool tech shop building in New York City. So I would say investing in technology, investing in showrooms, investing in growth globally so that more and more people find out that Peloton is a better workout, is a better experience for you to get fit and get those endorphins every day of your life. So it's investing in marketing, stores, technology, all the things you would expect.
Now, you were president of Barnes & Noble, right? So you know better than anyone how technology can change user behavior. People don't go to bookstores
That's right.
anymore.
100%.
They buy books online. So how do you see exercise habits changing? I mean, you want to go to where people are going to be and where the technology is going to be.
It's funny you bring up Barnes & Noble. You're absolutely right, Emily. The Nook and the Kindle are hardware and software platforms for consuming content at home. The Peloton bike and the Peloton treadmill are hardware and software platforms for consuming fitness content at home. You think about the digital disruption in media, think about back in the 80s when arcades existed. Today, arcades are gone because you have better experiences at home. So when you think about the Peloton bike and the Peloton treadmill, if you can get a better instructor, better community, better hardware, better software, at a better location, at better value with Peloton, you might not travel for an inferior experience at a higher price point.
So you've raised a lot of money. You are engaging in some more capital-intensive exploits, like building this huge showroom in Manhattan. How can you be sure the costs are going to be worth it?
Well, interestingly, we just did a Series F a month or two ago, led by TCV out here in the Valley, fantastic investors, and the founder of TCV, actually, Jay Hoag, who's been on the board of Netflix for the last 20 years. You think about Netflix investing close to $8 or $10 billion, you'd probably know, Emily, better than I do, in original programming every year. So for Peloton, we think content is king, and we are investing in content via these studios, whether it's in New York City or London or future global cities, for the content creation, daily, fresh content, 4 studios under one roof. So we have best indoor cycling, best boot camp, best yoga, a 4th vertical that we're going to announce in the coming quarters, so that we have the freshest, best content, the high production value, best instructors, all the stuff you'd expect from Peloton.
When's the IPO?
We're saying, interestingly, Dara Khadr, he's a good friend of mine, and he's always been a mentor to me, and he's saying that Uber is going out in 2019, and so I've followed suit. We're gonna go public in 19 as well.
All right, because Dara said so.
Exactly.
John Foley, founder and CEO of Peloton. Thanks so much for stopping by.
Thanks for having me.
Great to have you in the studio. Coming up, the tech that is matching cancer patients with treatments specifically tailored to them. A new platform that's got the backing of a Hong Kong billionaire to take it global. This is Bloomberg. A new global platform is aiming to revamp cancer care. Driver was developed by Harvard-trained oncologists and will attempt to pair patients with specifically tailored treatments from anywhere in the world. CEO and co-founder Will Polkinghorne told our chief North Asia correspondent Stephen Engel the startup launched in China, where the number of cancer patients is exploding.
Well, we didn't pick the timing. We've been in China for over 3 years. Since Horizons Ventures, Mr. Li Ka-shing led our Series A investment, we've endeavored to build our platform as a global one.
In a nutshell, how does it work and what need is it filling?
The problem that Driver solves is the following. We have a market failure right now in terms of how patients gain access to treatments. There's never been more treatments. 50 years ago, there were very few treatments. So the doctor did a pretty good job of interfacing with the cancer patient and getting them the right treatment.
There's a lot of information out there. But how do you get the right treatment?
There's tons of information. And so today, the only way a patient can get access to that treatment is through a physician. And the data is that physician is failing often to give the patient standard of care. So what that textbook answer is that a patient should get anywhere, and getting that patient access to the most advanced therapies in the form of clinical trials. So what Driver does is it says, look, instead of the doctor being by himself or herself responsible for clearing that market, what if we had a platform to help? We're not a new treatment per se. Driver is a middleman. We're an operating system between the patient and the doctor. But what we're hopefully curing is the treatment system itself. So as the cure for cancer treatment, hopefully we can speed up the development and the delivery of many more cures.
But is that marketplace, that ecosystem that is there between the doctor and the patient and what's out there, is that marketplace broken?
Broken. It's completely broken. And I think the data that it's broken comes from societies like the United States, where post-Obamacare, more than 9 out of 10 cancer patients have their care paid for. So as a society, at least in the United States, we've solved for that. Whether it's the government paying for it, your employer paying for it, yourself paying for it, some insurance paying for it, more than 9 out of 10, probably 95% of patients have it cared for. But too many patients don't get the standard of care. The overall statistic is hard to define. The numbers differ disease by disease, but there are some cancers where more than 60–70% of patients will not get guideline-based state-of-the-art standard of care. So I would say that's a market failure, meaning that the treatment exists, but the consumer's not getting it, and they have the ability to pay for it. Right. And the second market failure is how patients get access to clinical trials. And the number of Americans that get access to clinical trials is less than 3%. Yep. The number of Americans who would like to have access to clinical trials is more than 80%.
How does this fill the need as well to kind of bridge the gap that we've seen? We talk a lot about pilot shortages in the airline industry, shortage of this and this and this, but there are oncologist shortages in the world, huge.
Massive. There's a massive, massive, massive shortage of oncologists. So two really bad things are happening at the same time. One is there's not enough oncologists, and two, there's more and more cancer patients. So over the last decade, the number of cancer patients across the world rose by approximately 30%. The majority of that increase driven by patients in Africa and Asia. And so you take the fact that there aren't enough oncologists. In 8 countries in Africa, there are 0 oncologists. There's a tenth of the number of oncologists in China compared to the United States.
I think the stat is 18 oncologists per 1 million people.
1 million people, and that number is about 10 times that in the U.S. And in the U.S., we think we might have a 20 to 30% deficiency. So if we're not comfortable taking a part of the oncologist's job and migrating it to a technology platform, it means that you're comfortable with a lot of people around the world not having an oncologist at all. The way we're going to solve that is by bringing some of an oncologist's job today and migrating it to a technology platform.
You decided you are a technology company.
We are a technology.
You're not a healthcare company.
And we're not even a health tech company. And I'm not sure why in healthcare and medicine, if you're a tech company, you need an adjective in front of you. Health tech, digital health. I like to say that drivers know more of a healthcare company than, say, Uber is a transportation company or Airbnb is a hospitality company. We're a tech company.
But how much did this impact how you decided to seek funding? Because you didn't necessarily want to be beholden to big pharma or to the insurance companies, I assume. Is that correct?
Yeah, you're exactly right. So, exactly. Many people, when we were getting started, said, well, why didn't you start off with going to pharma? And we didn't start off going to pharma because while we wanted, and while we're really excited, and we've begun lots of conversations with pharma about how we can work with them, we wanted Driver to be a platform for the patient. And we wanted to build alignment with those two key stakeholders who are in that room when a patient goes on a treatment. And that's just two people. It's the patient and the doctor. And we wanted to build our platform with the patient being our primary customer, with alignment with our partner centers. And then now that we've done that, we're really excited to bring pharma in, but in highly patient-aligned ways that can augment their options.
Driver CEO and co-founder Will Pilkington speaking to our Chief North Asia correspondent Stephen Engel in Hong Kong. And that does it for this edition of Bloomberg Technology. Tomorrow we are heading to Boston. We'll be covering some of the innovative new tech coming out of the Boston hub and speak to Facebook activist investor Natasha Lamb and DraftKings CEO Jason Robbins. That's tomorrow.